Hello, good afternoon and welcome to Mutual Fund Corner on CNBC TV18. I'm Vinnii Motiwala, with me Sonal, Bhutra as well. Sonal, good afternoon, and a lot that's happened and come in from the AMFI data as well. So first, let's talk about that before we jump into what we're going to be discussing today with our guests as well.
Oh, yes. So we'll be discussing what's the activity been like in active and passive funds. But before that, let's talk about the data that came in from AMFI yesterday as far as mutual fund flows are concerned, because we did see some tapering off when it comes to equity fund flows overall. Now, remember, last month, we saw record high flows at 42,672 crore rupees. There's been some ebbing in that number. So 33,417 crores, that's been the equity flow number. Large cap funds, yes, there's been an improvement. So that decline that has come by, we'll discuss why that happened this time around. But large cap funds did well. We do have the mid-cap funds as well that saw an improvement on a month-on-month basis. That's also a multi-month high number for the mid-cap names that we are talking about. Small-cap funds as well. So all these factors did well. So what really went wrong this time? Let's look at other factors. Actually, the SIP number, that's been the big hit. We have been for last couple of months been saying, oh, record high SIP, record high SIP. This is not something we could say this month because it has come off by 200 crore rupees on a month-on-month basis at 28,265 crore rupees. Now, where has this decline come in from in the equity flows? Thematic funds, that has seen a decline from 9,400 crore rupees. It is now at around 3,900 crore rupees. Even NFOs, now remember, last month we saw high base because of Geo, BlackRock, AMC issuing those liquid funds, and that saw great response as well. But this time around, there's a sharp decline because of the high base that we've been talking about. If we talk about hybrid funds, that's where some decline has come by, because this was one category everyone was eyeing. But now there has been some decline there as well at 15,293 crore rupees. Balance advantage funds also saw a decline. There has been a decline in multi-asset allocation funds as well. Arbitrage funds, that also has seen a decline. And if we talk about the debt funds, there has been an outflow this time around. So overall, if we talk about the number, equity flows have come off from record highs, and it's not because of the usual large cap, mid cap or small cap. It's because of the other categories, be it multi-asset allocation, be it hybrid funds, which were actually the favorites a few months ago, have started seeing some decline come by there as well. And assets under management as well have seen a decline on a month-on-month basis, of course, because of the pool getting some month-on-month decline overall. So that's been the synopsis of what happened with the monthly data. We'll keep tracking that for you. But now let's get on to our conversation and welcome our guests on the show, Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, and Tanvi, Kanchan, Head NRI Business and Strategy at Anand, Rathi Shares and Stock Brokers. Chintan and Tanvi, good afternoon. Thank you so much for joining in. But lady, let me start with you first up. What has been the activity when it comes to passive funds this year so far? How much has the AUM increased? What kind of interest are we seeing from the investors here?
Hi, Sonal. Thank you so much for having me here. I think we have seen a very improving trend in terms of active versus passive. Indian markets, if you see 5.5 years back, passive funds barely had about like an 8% allocation towards total AUM, that the bifurcation was between active and passive. Whereas now you're seeing passive funds slowly creep into the percentage allocation that they have over active funds. So as on date, you're sitting at about 16% of allocation towards purely passive fund. And this inflection point, that is the major shift that happened between active and passive allocation in the Indian markets, you saw a very steep change from 2022, where a lot of money started going into passive fund strategies, a lot of money started going into index fund strategies. So that's where your major allocation, as on August data, stands with about 16.5% of the total industry allocation towards passive funds.
Right, Tanvi, point taken. And Chintan, coming to you for the same point, right? Anything that you would like to add to that? And, what kind of interest have you actually seen coming in from investors on this front as well? Anything additional in the recent months that we've seen in terms of a trend? And in the past, how have these performances been of passive fund versus active fund in the last few months that we could talk about?
Yeah, thanks, Vinnii, and hi, Sonal. If we look at India as a structural market for the last 15 years or so, we moved from a time where people used to say fixed income towards equities. Now, within equities, we basically started bifurcating into mutual funds and direct equity investing. Within mutual fund, it is now being active versus passive. So I think this discussion around active versus passive is, of course, borne by the fact that we have much larger product suite now in the passives. I think just in the last 1 year, more than 100 passive funds have been launched. That's because all the AMCs are now filling in their bucket in terms of having the options for the investors to put money. Having said all that, we do believe that active funds, because of the structure of the Indian market, have a lot to offer. And so in India, both active and passive will coexist for the longer run, because unlike some of the Western markets or even the Asian markets, India has a diversified equity sectoral bouquet which is available. And so fund managers who are actively managing their funds always have something to create alpha from. So in India, which is anyways underpenetrated as far as financialization is concerned in equities, only 7% of our total savings is in equities. We do believe equity and active and passive both will continue. The trend in passive is, of course, encouraging. It's mainly led by, of course, the pension assets coming into the markets. And so of the 12.5 lakh crores, if you look at it, a large portion is still led by institutions and pension funds. So the actual on-ground retail HNI activity in passives is improving and increasing. But still the active is where the larger chunk of the money is going. And I still believe that both active and passive will grow in India because the scope to grow in India in terms of active passive is growing. And the numbers which you were mentioning about mutual funds and, the fall in the, let's say the incremental flows that has happened between July and August. One thing we must remember is that if you just look at 10 years back, these numbers were sub 3,000 crores a month. So 33,000 crores a month is still not bad. And this continues to be a strong rebuttal to the FIs who've been selling in India.
Of course, it's not bad. It's just that everyone's been so used to an increasing trend on a month-on-month basis that it has come in as a bit of a disappointment after seeing record numbers. But of course, after record, after peak, something or the other keeps seeing a decline. So we understand that. But the SIP number, of course, has been a big data point to take forward from this month's number as well. But Tanvi, let me come to you. Have we seen better performance from passive funds versus active funds in the last few months? What has the trend been like so far?
So if you even take a longer term CAGR, you take a 3-year kind of a performance, and you track your broader active funds with your benchmark indices. So whether you take a large cap category of Nifty 50, do a 3-year CAGR and also compare it with your active funds, you see your benchmark index at somewhere in the range of 12.5%, whereas your active fund managers have generated a return in the range of 19 to 20%. Similarly, if you take a small cap index, that is 150 or your Nifty small cap, your performance has been in the range of around 20%, whereas your actively managed funds still have generated an alpha of around 2 to 3% to the tune of 23-24% in terms of return generating capability. So when you're seeing the data points in India with regards to broader indices, at least, leaving the thematic, leaving different kind of, these strategic indices that have come in, if you take just the broader index fund, you're still seeing active fund managers able to generate an alpha over and above their passive counterparts. And as Chintan very rightly said, that there is still a level of information arbitrage that is present in India as compared to our peers or our global counterparts, where to generate an alpha in the market becomes very difficult in the global space or in the developed market space as compared to India. Here you have a much more structural theme. Here you have a much more longer term theme that kind of gels well with the investment philosophy of active fund managers, where they not only chase returns. One is the return generating potential of the portfolio. The other is also the risk measures. The active fund managers are able to have a lower standard deviation in the portfolio, a certain level of beta to the portfolio vis-a-vis the benchmark is maintained. So with regards to both the strategies, again, on a longer term, we have seen active fund managers do generate a certain level of alpha on their portfolios.
Absolutely. There's some generation of alpha for the long term that comes in for active versus passive funds. But Chintan, if someone has to pick now in their portfolio, how should they be allocating, or how should they choose, passive funds versus active funds, or over a conservative, medium risk, high risk investor? For all these type of investors, how should they be dividing this now?
So I think investor behavior is very interesting. When the markets are doing well, even the most conservative investor becomes an aggressive investor and vice versa. So rather than focusing on the category in which an investor belongs, let's possibly take it a general outlook that asset allocation is the key to long-term success. And within asset allocation, as the bouquet suggests, you will have a certain allocation to dynamic asset allocation schemes. We generally say 40 to 50% should be a good allocation to dynamic asset allocation schemes because they will probably give you a steady long-term uh, base on which then you can create alpha through the other part of the portfolio. And the other part of the portfolio will have 25 to 30% in value categories, special situations, mid caps, small caps, as the case may be. And then there is 25% left for passives, and within passives, I'd include silver, gold ETFs as well. So I think a portfolio mix of having a good, steady allocation to dynamic asset allocation schemes. Within dynamic asset allocation schemes, of course, now you have aggressive and defensive options. So you can mix that. Along with that, you have the active schemes in mid cap, small cap, and diversified equity. And in the passive schemes, nowadays we're seeing people being very active in terms of sectoral and thematic allocation. So if someone had a view that, okay, the GST cuts are going to benefit the FMCG or the consumption sector, they can invest in the FMCG and the consumption basket to the passive funds which are available within that space as well. So we are seeing a tactical allocation, but it's still infancy stage in India in terms of the passive allocations. We have a long way to go, and we do believe that both active and passive will have their space in an investor's portfolio. But the mix will keep changing. Today, of course, the flavor of the season is silver ETFs and to an extent gold ETFs. But if an investor always had a balanced portfolio, they would get the benefit of all asset classes performing in India.
Oh yes, what a move on silver, right? We've been talking about gold, but silver surreptitiously came and has made a one-way move there. But Tanvi, let me come to you on this question itself. If one has to choose, of course, every investor appetite is very different, but how much of their portfolio should be into passive versus active for different risk categories?
So I think it's something with regards to behavioral finance as well, where you look at time horizon, you look at your investment preference. Again, the active versus passive should not be either or, it should be a combination of both. So when you're even looking at a broader portfolio for a conservative investor, you can look at adding, say, a larger percentage allocation towards large cap followed by mid and small cap strategy. So a passive fund can be with regards to large cap, whereas a small, mid, and maybe a gold or a silver ETF can be added with regards to diversification there. So you can look at like a 70-30 blend with regards to passive and active. If someone's extremely conservative, then going up the chain with someone who's moderately aggressive, you can look at a 60-40 with 40% allocation towards passive funds. Again, even within passive funds, you can look at different trends that are there. You can look at different thematic trend, sectoral trend that does gel well with the kind of investment outlook that one has. You did see a lot of NFOs come in defense. You saw, a sort of outperformance of these particular NFOs also, but then there was also a very big hit that they took. So someone has to be very cognizant when they're taking a call on which sector, which scheme. So basis that, I think a broader portfolio allocation or blocks can be built on the basis of thematic, large cap, even allocation between your commodity ETFs and so on and so forth. So
okay, that's the view coming in there, of how one should be looking at active passive. Have all of that in your basket as well. But on that note, we're going to actually sip into the short break that we have to take right now. Don't go anywhere. We still have this discussion left. We have to discuss a lot more in terms of opportunity that lies here as well. So stay tuned in for that. Welcome back to Mutual Fund Corner on CNBC TV18. Now, let's continue the discussion on active as well as passive funds as well. We still have with us Chintan Haria as well as Tanvi, Kanchan as well. So continuing the discussion, Chintan, let's start this time with you in terms of overall, where does India stand in passive investing versus maybe you would compare in terms of global benchmarks or global countries?
So if you look at the global landscape, there are pretty much only two countries where passives have picked up massively in terms of retail investing. One is US and the other is closer to home, that is Korea. But if you look at the US market, it's 50% of the global market cap, right? So US is huge. I think more than $60 trillion of market cap versus $100 trillion globally market cap. And within that $60 trillion market cap, a lot of it, almost $12 trillion is ETFs, because of the fact that in US, the ETFs get taxed at a beneficial way compared to the mutual funds. So in ETFs, you don't need to pay tax on your unrealized gains in US. While if you are holding a mutual fund, even on your unrealized gains, you have to pay a tax, and hence the entire industry in US over the last 7, 8 years, maybe 10 years, has shifted towards ETFs. And in US, you have active ETFs as well as passive ETFs. So some of the trends in US are that active ETFs, or rather the active mutual funds, have also been converted into active ETFs because of the fact that they have a taxation advantage. That's peculiar to US, and hence you've seen US passive ETFs going up significantly. In India, if you look at it, the trend is pretty clear. Institutions and also the advisory, which basically is also growing, plus family offices, which have their own structures, are preferring investing through ETFs and index funds wherever they have a strong view and they want to participate in a known theme. Those are, I would say, tactical allocations. They are not necessarily strategic allocations, apart from the broader indices which have 500 or 50 stocks. So in India, the landscape is changing. But if you see in India, probably the largest weight in the broader indices would be in the range of 11 to 12%, or maybe 10%. While something in Taiwan would have the largest stock is about 56%. In Korea, it is also quite high at more than 25-30%. So India offers that diversity, and hence active and passive will both coexist, because active fund managers will deliver alpha, while the family offices and those who want to take those calls strongly on certain sectors and themes can go the passive route, and that gels well with the kind of breadth of products which are now available. Earlier, it was only, say, IT ETF or banking ETF which was available. Today, if you look at it, you have an option of oil and gas ETF, FMCG ETF, IT, banking, infrastructure, etc., etc. So the wider the choice, the more investors get a chance to invest in the market through the ETFs. But it will still be led by institutions and pension funds as far as India is concerned for a while, because in India, still the retail on ground does not necessarily understand the markets that well. And so seeing a significant increase in the institutional side on ETFs, while the mutual funds will continue with the distribution and advisory going the way it is right now.
Yeah, and as you pointed out, in US, the tax benefit really works. It's a pass-through in terms of dividends that is given to the investors, and that's why they prefer ETFs over mutual funds. If that happens in India, maybe we could see them warming up a lot more to ETFs in general. But Tanvi, let me come to you. And this is something I would like to ask you, Chintan, as well. And if we can do it quickly, because you mentioned consumption FMCG themes could work right now and investors could look at that particular theme. But aren't some of the passive funds sectoral? So how do you look at that considering the volatility we keep seeing in sectoral funds? Who should go about it? Tanvi, let me start with you, and then Chintan, please come in on that as well.
Sure, absolutely, Sonal. I think you're seeing the kind of inflow dry up as well in certain sectoral funds. And this is something that is changing with regards to trends. So when you're looking at sectoral funds, you also need to look at what are the sectoral funds that are cyclical in nature. You had a huge influx coming in defense. You had a huge influx coming in pharma as well. You saw defense and pharma both generate about 46-47% kind of a return and then dry up immediately thereon forth. This structural change has also happened because pre-COVID and post-COVID, you had about 4 lakh odd demat account with regards to India. And then post that, you had a huge influx where there was almost 20 odd crore of addition. So 4 crore to 20 crore is what you saw an addition in terms of pre and post COVID, just purely the number of people coming in the Indian markets. So the major trend that also continued over there was the sectorial thematic funds that did kind of over or supersede your broader large cap, mid cap, small cap kind of a market cap funds that were there. So you did see a very major shift in trend. However, whenever someone is looking at these particular sectors, they also need to be very cognizant of the risk that these sectors do carry, and the kind of returns that they're expecting from these particular sectors. So
Right.
you will have to be extremely, you'll have to look at your portfolio in terms of rebalancing as well. Right now, the GST does have a positive impact. The US tariffs had a negative impact towards certain sectors. So when you're looking at a sectorial or thematic allocation in your portfolio, you'll also have to be very cognizant with regards to the level of rebalancing you're looking at in your portfolio. So that's something that investors looking purely in sectorial or thematic investments with passive fund strategy will also have to somewhere use a passive
Sure.
fund as a way of getting an allocation and then rebalancing.
Okay. That's a view coming in there. But, with that, we're actually absolutely out of time on this edition of Mutual Fund Corner on CNBC TV18. Tanvi as well as Chintan, thank you so much for joining us on the show. And viewers, thank you so much as always for, joining us, watching the show as well. But remember that next week, I think we should start doing queries as well. So please send us your queries so we'll solve them as well. But thank you so much from Sonal, me, as well as the team who put the show together. Thank you so much for tuning in.